Here to react is Moody's Analytics chief economist, Mark Zandi. Mark, happy holidays. Thanks for being with us.
Thanks, Carl. Happy holidays.
Any reason to think that claims are going to move into dangerous territory anytime soon?
Doesn't feel that way. I mean, that's really good news. I mean, layoffs remain very low. I mean, 1 week affected by holidays and timing and seasonal adjustment and all kinds of measurement issues. But feels like underlying UI claims weekly is about 225K. That's good. Anything over 250, I'd start paying real close attention. 275, I'd start setting off yellow flares, and 300K would be recession. So we're not anywhere close to that. But it's fortunate, though, Carl, because businesses still aren't hiring, and as a result, there is no job growth. Job growth at best is flat, and I suspect is even down after revision. So fortunately, businesses aren't laying off. That's the key to keeping the economy moving forward and avoiding a recession. Yeah,
a lot of chatter today about when you print a 4.3 quarter on GDP and the average growth of jobs per month is 51K, the spread between economic growth and hiring, a lot of people argue, will be one of the major themes of 26.
Yeah, I don't know. I mean, that's 1 quarter. I mean, the data is going up and down and all around. It fell in the first quarter. I mean, if you take a year-over-year growth rate to abstract from the vagaries of the quarterly data, it's 2.3%. And I suspect Q4 is going to be weak, probably closer to 1. Obviously, the government shutdown will play a role there. That will put year-over-year growth at 2. And to me, that's underlying GDP growth. That's where the economy is abstracting from the vagaries of the data. At 2%, if you have, productivity growth that's 1.5 to 2, you're not going to create a whole lot of jobs. So it feels pretty consistent to me.
You actually say the 4.3%, I mean, that it's fragile growth. What do you mean by that? And which way do we go? And are there things, prods that can push it in either direction?
Yeah, you're reading my notes. I'm glad to see that. I was worried that I would write them and no one would read them, but you're reading them. Yeah, it's fragile because we're not creating jobs, Melissa. I mean, I don't know how we can feel comfortable about the way things are going if we're not creating jobs. And unemployment is rising. It's still low, 4.6%, but that's now meaningfully above, I think, most estimates, including my own, of the full employment and unemployment rate. That's closer to 4. You can see wage growth is slowing, consistent with that. So that, to me, is a very fragile situation. I mean, if anything doesn't stick exactly to script and consumers pull back a little bit, then, we're going to see some job loss, and that's the fodder and then layoffs, and that's the fodder for an economic downturn. So I don't know that I'd take a whole lot of solace in the 4.3. I mean, I think what really is key here is jobs. Now, there's a lot of factors that could swing it one way or the other. On the upside, we got a lot of monetary and fiscal juice coming, and maybe even more than we think. We could get another reconciliation bill that could provide stimulus. The tariffs could go away. Half of them could go away when the Supreme Court rules on the reciprocal tariffs, and the president may not, find another way to raise tariffs. That would be helpful to the economy. And the Fed could step on the accelerator more than anticipated. Fed independence is certainly an issue. So that's the upside. The downside, it goes back to AI. I mean, AI is powering a lot of economic growth. And by the way, Melissa, that's the one factor that surprised me most in 2025 was just how much juice it provided, both through investment and the wealth effects. But either investors are right about what's going on, and we're going to get a lot of productivity growth. And with no job, that might mean job loss. And that makes me nervous. Again, going back to what I said earlier. And then conversely, the investors could be just wrong about the strength of the productivity growth and the profitability that we're going to see here. And if that's the case, the stock market's going to correct, and that's going to knock the legs out of one of the pillars of growth, and that is the high stock prices, AI stock prices, and the wealth effect that generates. So there's risks on both sides of kind of this fragile growth that we're experiencing.
Yeah, that's a key risk for many going into 26. Mark, did you go back and try to give us a cleaner read on CPI? Was it warmer than a 2.7 or?
Yeah, I mean, I was pretty annoyed by that CPI. I mean, I get it. I mean, the Bureau of Labor Statistics had to make some choices about what they were going to do with the month of October because there was no survey given the government shutdown. So, no matter what assumption they made there, there'd be a lot of questions. But they assumed basically no inflation, no change in prices for the vast majority of goods and services in October, and obviously that makes no sense whatsoever. So we went back, good product by product, good by good, service by service, looked at what private sector data we had. We have our own ways of taking that and translating that into what it means for CPI. calculated CPI based on that set of assumptions, and we're right back to 3%. So in my thinking, inflation, CPI inflation is 3%, which is, obviously well above the Fed's target, which on CPI is probably closer to 2.2 or 2.3%. So we're going to keep track of this, for at least for a year until we get to next October, because the year-over-year numbers are going to be biased lower as a result of the choice the BLS made here. There's other biases as well, but I won't, nerd you out on those things. But that was the biggest thing.